Yeah, so in our previous class, we had started looking at consolidated financial statements, and we had already, in this case, defined a few terms here and there. What is consolidation? What is a group? What is a subsidiary? What is a holding company or the parent company? We had also, in this case, looked at the group structures, and we had started looking at special transactions in group accounts or consolidation, and how, in this case, they'll end up having to be tackled or end up having to be treated in the consolidated financial statements. So we had started by having to look at, in this case, what we call intercompany sales and URP, or unrealized profit on closing stock, where we said, in this case, if it happens one company was having to sell to the other, you eliminate. How do you eliminate? You deduct the intercompany sales. For example, if the holding company sold to the subsidiary, you actually deduct from the cost of sales. You also deduct from, in this case, what? The sales. Ideally, in this case, you do what? You end up having to debit the sales account, you credit the cost of sales. If it happens that these goods that are having to be sold to the other company, they are still in stock by the end of the period, in the closing stock, you calculate what we call unrealized profit on closing stock. And in this case, we said this calculation of the profit should actually be based on, in this case, what we call the margin, or on the selling price. So the margin, if it's actually the markup, you actually convert, in this case, to what? To the margin, to be able to know what was the unrealized profit on, in this case, what? On the closing stock. So with this one, we said you debit the cost of sales, you credit the closing stock or the closing inventory. So once we do a question, we have done some illustrations or examples, but once we tackle a question, you'll now, in this case, even be far much better to be able to comprehend. So I want us, in this case, in our today's class, we start looking at the second special transaction, and how, in this case, you likely end up having to deal with it. So we had done number one. Number one was, in this case, what? Intercompany sale, and of course, unrealized profit on closing. So today I want us, we start by having to look at number two. Number two, hope you're able to see here. Hope you're able to see here. Hope you are able to see here. We have what you call intergroup balances. Intergroup balances. Intergroup balances. We have what we call intergroup balances. You write intergroup balances. You write intergroup balances. Intergroup balances. You write intergroup balances. Intergroup balances. Yeah. So intergroup balances. So you write this about intergroup balances. This refers to intercompany indebtedness. It refers to intercompany indebtedness. So it refers to intercompany, refers to intercompany indebtedness. Indebtedness. It refers to intercompany indebtedness. Is where one of the companies is a debtor to the other by the fact of the virtue that, in this case, one of the companies supplied goods to the other on credit. So like in this case, the holding company ended up having to sell to maybe the subsidiary, some goods on credit. So they sold goods on credit. And therefore it means this subsidiary actually becomes a debtor to this one, and this holding company becomes a creditor to this subsidiary. So this is because this one is the one that sold. This one sold goods. So if they sold goods on credit, it means this one will likely become what? This company, the holding company, is the debtor to this one, while this one is the creditor to this one. So maybe these goods that were actually sold on credit were maybe, in this case, worth maybe, let's say, for example, 300,000, 300K. They were 300,000. So it means this company will be under obligation to pay this one, the 300K. While in this company, the holding company will be anticipating to get this 300K. So this one becomes the debtor to this one becomes the creditor to this one. So it brings about what we call what? Intergroup or intercompany balances. So it refers to the indebtedness that will arise amongst the members of the group. So we call it what? Intergroup balances. So how do we treat these intergroup balances? That is now the question. That is our main focus. That is our main concern for us to be able to know how we treat what? The intergroup balances. So it is a case where group companies owe each other. Just continue and say, it is a case where group companies owe each other. It is a case where, it is a case where members of the group, or each other, members of the group or each other. And therefore it brings about what we call what? Indebtedness. It brings about what we call what? Indebtedness. So it can arise as a result of, as a result of sale of goods on credit, to another company. It can arise as a result of sale of goods on credit to another company, company. Then you write and say, in this case, the intergroup balances, the intergroup balances will be eliminated. The intergroup balances will be eliminated as follows. The intergroup balances will be eliminated as follows. So how you'll end up having to eliminate them, this is the entry you'll be able to pass. So what you'll do, so because now in this case, you know, this one is a creditor, is a payable. So this one is a payable to this one, and this one is a debtor, or what we call a trade receivable. This one is a trade receivable to this one. These are trade receivable to this. So what the entry you'll be able to pass, or what you'll be able to do to eliminate, you'll end up having in this case to do what? To eliminate. So the intergroup balances will likely be eliminated. How do you do it? What you do, you debit the trade payables, by these what? Intergroup balances, the trade payables, and in this case you credit the trade receivables. What this one means, you simply deduct that amount from the trade payables, and also you, in this case, you deduct from that amount from, in this case, what? The trade receivables. You deduct. So like in this case, you see the amount that is involved is 300K. It is 300K. And of course, when in this case, we now proceed and actually look at how you present it, because these ones are paying the statement of what? Financial position. So you'll be given, in this case, the holding company, and of course, in this case, the subsidiary. This is how you'll be presented with the trio balance. So you'll likely be told, in this case, you have what? Trade payables. We have trade payables. For this H, trade payables for this H, maybe in this case, it is actually how much? 700K. Trade payables for this S is maybe in this case for the subsidiary. So these are in the books of the holding company. The trade payables is 700K. For the subsidiaries, maybe in this case, 650K. Then you'll also be told the trade receivables. You'll be told the trade receivable. This is what you'll be presented in the question. I'm trying to explain. The trade receivables, you'll be told that in this case, for the holding company, is maybe in this case 560K. And for this one is maybe in this case 720K, like that. So, you know, when you talk about having to consolidate, because that is what you are learning, how in this case you combine the books of accounts of the holding company and those ones of the subsidiary. So with pertaining to the statement of financial position, because these are items of the statement of financial position, you normally in this case end up having to add them line by line to consolidate them together. If the assets, you add them line by line, you put them together. So it means in this case, if you are consolidating to come up with a consolidated statement of financial position, what will be happening, ideally for the trade payables, we'll be taking, to get the trade payables in the final statement, this consolidate, the one is combined for this and this, we'll be adding 700K plus 650K. And of course, in this case, for the trade receivables, we'll be adding 560K plus 720K. But of course, you're having to say, if it happens, you are told that the holding companies was basically expecting, they sold some goods on credit, which in this case are yet to be paid. So they sold some goods on credit to this one, which are not to be paid. It means there's what? An intergroup balance, an intergroup owing. This one is owing this one, like this one. It is owing this one, what? 300K. We're having to say you do what? You debit the trade payables By having to debit, it means in this case you're less 300K. You come also less here 300K. You would have actually been able to deal with that kind of what? An elimination of what? Of the intergroup balance. So if you're having to minus, you know, when when you're having to deduct trade payables, you normally debit. That's why you're having to say you debit, because trade payables is a liability. Liabilities normally have credit entries. When they increase, they have a credit entry. When they reduce, you debit that account. So if it is reducing, you debit, or in short, you can just be able to remember to eliminate them. You deduct from the trade payables, you deduct from the trade receivables. The trade receivables, if you're having to reduce them, if you're eliminating from the trade receivables, you credit. Is an asset. When assets increase, you debit. When they actually reduce, you credit. So that's why you're having to say you eliminate the intergroup what? Balance. The intergroup balance. You eliminate the intergroup balance. You end up having to eliminate what? The intergroup balance. But sometimes there can be something that can actually happen. You might actually, in this case, be told that the intergroup owing is actually 300K. But ideally, there's some money which has actually been paid by this company, which is still what? Cash in transit. It is yet to be received. It is yet to be received by the holding company. So this company was expecting 300K from the subsidiary. But because they have already made a payment, maybe it could be by check, but it's still on the way. It is still cash in transit. So what will be happening, this particular company here will still be recognizing this amount from the subsidiary as what? As a trade receivable. They still actually be recognizing it as a trade receivable because they are yet to receive the money. But already, this company would have eliminated that 300K because they have already paid. It's only that in this case, this holding company is yet to receive the 300K. So as this one is still recognizing, in this case, what? The full amount. This one has already reduced this what? Trade payables, because they have already, in this case, done what? Paid the amount. So if there's exactly what we call a cash in transit, then the entries change a bit. You now include the account for the cash in transit account. And of course, this is how you'll be able to treat it. You can be able to write another paragraph, write another paragraph, write another paragraph, write another paragraph. Any cash in transit need to be adjusted, Any cash in transit need to be adjusted before eliminating the intergroup balances. Any cash in transit need to be adjusted before eliminating the intergroup balances. So any cash in transit need to be adjusted before eliminating the intergroup balances. So these are, you'll be able to eliminate it. So before eliminating the intergroup balances, full stop, then you will say the following entries will be passed. The following entries will be passed in the books of accounts. The following entries will be passed in the books of accounts. The following entries will be passed in the books of accounts. The following entries will be passed in the books of what? Books of accounts. The following entries will be passed in the books of accounts. The following entries will be passed in the books of accounts. So what will happen here? You'll actually, in this case, end up having, you'll debit the cash in transit. You'll create a cash in transit account. You'll create a cash in transit account. Then in this case, you also debit the trade payables. Debit the trade payables with the amount that is still owing. Debit the trade payables with the outstanding amount. Then in this case, you credit the trade receivables account. 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 So you'll likely end up having to debit, in this case, what? The cash in transit, because this money is just still on the way. So it is cash that you're yet to receive. You won't include it among it the cash, because in this case, there'll be another account for, in this case, cash. You might be told there's also cash. Maybe cash is 620K. Maybe cash is also, in this case, for these other companies, maybe 300K. You won't actually include it here because it is yet to be received. You'll just recognize this asset in the consolidated financial statement. But now you'll be able to introduce another asset. You'll call it cash in transit. Then then that amount of the cash in transit you'll be able to put here. But now the difference is the one that we'll be able to deduct from, in this case, what the trade, because these ones they have already paid. You know, they have already reduced their trade payables. They have already reduced their trade payables by this cash in transit. So the amount in this case you'll be eliminating, it won't actually be full amount because they have already, in this case, what settled. They have already settled. So if that is the case, then you debit what? The cash in transit, debit trade payables, and of course credit what? The trade receivables. So like that. That's what in this case will likely happen if you have in this case what? A cash in transit. So we'll come across a question, and of course you'll be able to see how that one is actually handled. We can go to another one. We can have what we call what? Intergroup sale of what? Fixed assets. We can have another one. We call it intergroup sale of fixed assets. So one of the members of the group ends up having to sell a fixed asset to the other member of the group. What are the entries that in this case you'll end up having to pass? We can have intergroup sale of what? Fixed assets. Number 3, intergroup sale of fixed assets. Intergroup sale of fixed assets. So number 3, you can write intergroup sale of fixed assets. Intergroup sale of fixed assets. So just from, so one of the members of the group is selling fixed assets to the other one. So you write this about intergroup sale of fixed assets. You write, this is the sale of a fixed asset by one member of the group to another member of the group. It is the sale of a fixed asset. It is the sale of a fixed asset by one member of the group to another member of the group. It is a sale of a fixed asset by one member of the group to another member of the group. To another member of the group. Full stop. You write, in case of this transaction, 2 adjustments need to be made. In case of this transaction, 2 adjustments need to be made. If it happens, maybe the holding company sold to the subsidiary or the subsidiary sold to the holding company, what we call a fixed asset. So if this is the case, 2 adjustments need to be made. In case of this transaction, comma, 2 adjustments need to be made, semicolon. So what is the first adjustment? What is the first adjustment? So the first adjustment, it is to eliminate any profit recognized. So elimination of what? Any profit recognized on the sale of the fixed asset. So eliminating, the first one will be dealing with what? Eliminating any profit recognized, any profit recognized, any profit recognized on the sale of the fixed asset. Any profit recognized on the sale of the fixed asset, you eliminate it. So sometimes they can tell you that in this case, there was a fixed asset which was actually sold to another member of the group at a profit. That's how the additional information will be able to read. Like they'll tell you that the holding company sold a fixed asset to the subsidiary at a profit of this much. At a profit of this much. Or in this case, you likely, in this case, by yourself calculate and realize, maybe you'll be told the acquisition amount, the accumulated dip, the disposal price. So in this case, you do the differences there, you realize there was a profit. If you realize that in this case, there was a profit on the sale of the fixed asset to the other company, you have to eliminate what? That particular what? Profit. And how do you eliminate it? How do you eliminate it? So in this case, what you do, you debit the cost of sale account, or sometimes you can be able to say you debit the retained earnings account. You debit the retained earnings account, or maybe in this case, you can be able to say the P&L account. The P&L account, you debit. So, because in this case, you know, with profit, if the profit increases, you normally credit. It is a credit entry in the P&L or retained earnings account. So if in this case, you're having to eliminate it, it means you debit. This is an income account. P&L is an income account. So whenever it increases, it means you'll always be passing credit entries. But when you want to reduce it, you debit. And then this one is an expense. So because now in this case, you're having to eliminate, you'll basically eliminate by having to recognize it in what we call what? The cost of sale expense. It will increase this particular expense here. So we'll increase this expense to eliminate what? The profit. So you can be able to say debit the cost of sale account, or debit the retained earnings, or debit the P&L account by that what? Particular profit. Then in this case, you credit the property, plant, and equipment account with that profit. Credit the property, plant, and equipment account. You credit the property, plant, and equipment account by that amount. So those are the entries you'll be able to pass. In any case, you are told that the asset was actually sold to the other company at what? At a profit. To eliminate that profit, you debit the cost of sales or the retained earnings account or the P&L account. Then you credit, in this case, what? The PPE. So what will be happening? What will be happening is that you'll likely be, these are what you'll be told. This is what you'll be told. So it means in this case, you know, this cost of sale will have, in this case, the holding company, and of course, in this case, what? Maybe the subsidiary. So you'll be given the figures. You'll be given the figures in the question where you'll be told that the cost of sale of maybe the holding company is maybe 60K. Then the cost of sale of, in this case, the subsidiary is maybe, in this case, what? 56K. 56K. You'll be told like that. So it means what will be happening, once you have this kind of thing in the additional information, you'll calculate what is the profit that was recognized on the sale of this fixed asset. Once you calculate it, you have to remember the entry. The most important thing is to remember these entries here, because they'll be able to guide you once you start having to consolidate which basically adjustments you will be making in those kind of consolidations. For example, if you're having to, in this case, combine, because consolidation is ideally having to combine what is in the income statement and what is in the statement of financial position. So when you start having to prepare the consolidated income statement, the CIS, you'll be taking this figure you add on this one. But now in this case, what you have to remember, if it is the income statement, you have to look at the period upon which it was actually acquired. You can be able to apportion when the subsidiary was acquired. But let's assume it was acquired for the entire year. So it means in the consolidated income statement, our cost of sale will actually basically, in this case, be in bracket 60K plus 56K. But now we have to, in this case, eliminate. We have to add this amount, because you're having to say, do what? You debit. We'll have to add this amount of what? Unrealized profit. We have to add it here. Let's assume we have calculated it has come to maybe 2K. So it means we'll come here and, of course, add what? 2K, like that. So that we would have actually been able to do what? Proper adjustments for the consolidated what? Income statement. The reason as to why in this case it will end up having to reduce the profit. Ideally, when this cost of sale increases, the profit reduces. Because in this case, you'll take the revenue or the sales here, you deduct the cost of sale. That's why you're having to say you have to eliminate that profit. How can you eliminate it? Including it under the cost of sale. When you include it under the cost of sale, automatically you'll be reducing the profit, because to get the profit, you take the sales, you minus the cost of sale. Once this one increases, the profit goes down. You'll basically be reducing the profit. Or ideally, in this case, maybe you can actually be given what? The retained earnings. You basically do what? Debit the retained earnings account, which is basically an income account. But also in this case, to do that, you simply add on what? The cost of sale. So what you have to remember also, in our very, very fast adjustment, the other adjustment I, of course, in this case, told you will be able to deal with them. For example, what will be happening, you'll be taking 60K plus 56K plus 2K. But you have to remember also, if there's an intergroup sale of goods, in the first adjustment, intergroup sale will basically be deducting. Maybe in this case, we calculated in our number one, we got the intergroup sale was actually 6K. That one will be deducting. We'll have to actually be eliminating it like this. Or maybe in this case also, we had what? Maybe unrealized profit on what? On the closing stock. Which in this case, we said you'll likely end up having to do what? You debit the cost of sale. And of course, in this case, you do what? You credit in this case what? The closing stock. So that one means in this case, that one will also in this case end up having to do what? To add. So it just depends with what? The adjustment. And of course, you can be able to see in our first three adjustments that you've looked at, the cost of sale is having to be affected. So all those adjustments, when in this case you're having to consolidate, you'll be taking the cost of sale of the holding company, you ideally add them. But now you remember those adjustments. If in this case is, for example, this one you come and add. If it is in this case intergroup sale, you deduct. So that in this case you can get the correct figure for the cost of sale in the consolidated what? Income statement. So that's what in this case will likely be happening. For this one, this item, it appears where? In the statement of financial position. So it means in the statement of financial position, this is what the question will be giving you. It will tell you that the property, plant and equipment is maybe in this case what? 10K. For this one is actually maybe what? 33K. So in this case, it means if you've calculated this one to come to 2K, when we'll be consolidating, now note this one, It is now the statement of financial position. We'll be saying property, plant and equipment. We are going to add 10K. We are going to add 10K. We are going to add 33K, but now we have to remember there was unrealized profit on what? Sale of fixed asset, which in this case has to be adjusted in what? Property, plant and equipment. If you're having to credit, it means you will deduct 2K here. Crediting the property, plant and equipment means you are deducting from that what? Account. Because it's what? Is an asset. When an asset is credited, you are ideally having to minus. So it means in this case, we will be consolidating here. We'll comfortably start preparing our SFP. But now, the first item, property, plant and equipment, we add line by line, 10 plus 33. But you have to remember that we deduct. So that in this case, we get what? The correct figure to go to what? Into the SFP as what? Property, plant and equipment. So that's basically in this case how these adjustments will eventually affect, for example, in this case, what? The final accounts, which now in this case are the ones we'll likely be preparing. So number B, you can write number B. Number B here, there can be another what? Adjustment. There can be another adjustment. So you can be able to write adjusting for overcharged what? Depreciation. Adjusting for overcharged depreciation. Adjusting for overcharged what? Depreciation. So remember, if you are eliminating this amount, if you're eliminating this amount from the property, plant and equipment, it means if we calculated the depreciation for the year on the initial figure, let's say for example, in this case, the initial figure was actually what? Was actually this one. It was actually 10 plus 33. So it was actually 10 plus 33, which was coming to 43. So when we had calculated the accumulated dip, we had considered this figure. But now remember, we've reduced it by 2. So it has come to what? 41. So you have to eliminate this depreciation on this amount because you are eliminating it. So this amount, you are eliminating it from the property, plant and equipment. Remember, the figures you used to calculate depreciation were the ones which were there. 10 plus 33, which came to 43. But now, this value, this cost of this value of the property, you've reduced it. So it means if it is being reduced, it has an effect also on what? The depreciation that had actually been recognized. So you have to, in this case, do what? Adjust. It had been overcharged. It was on this one, but it was supposed to be on this one. Because you've done what? You've actually eliminated the value of what? Property, plant and equipment by what? This one. It had been overcharged because it was 43, but now we have gotten the correct figure. It is now 41. It means in this case, you're supposed to be considering depreciation on what? 41, not 43. So it means there's what? An overcharge on this amount, which in this case, you'll have to calculate and of course, in this case, do what? Do the adjustment. So if that is the case, there'll be an overcharge depreciation, which in this case, you'll be able to pass these entries. You'll debit, you'll likely debit, you'll return it back. Debit the property, plant and equipment account with that overcharged what? Depreciation. Then in this case, we'll end up having to credit the income statement, or in this case, you'll likely end up having to credit, or maybe in this case, reduce what? You'll credit the cost of sale. You'll credit the cost of sale, or you can probably say you'll credit the retained earnings account. Because when you basically, in this case, if you correct an overcharged depreciation, it increases your profits. If you, in this case, you had overcharged depreciation, then you correct it. You know, when you overcharge, it means it reduces what? Your profits. An overcharged depreciation basically reduces your profits. But to correct it, in this case, you need to return it back to the retained earnings or the profit account. So you can be able to credit, or in this case, you can say credit cost of sale. When in this case, you reduce the cost of sale, you likely basically now be correcting that kind of what? An overcharge. So you likely in this case come and actually debit. You'll calculate. Remember the overcharge was this. It was this particular profit. Maybe you'll be told depreciation on the item of plant was 10%. So you'll take 10%, multiply by this overcharge, 2,000. You'll be able to get what? 200. So it means in this case, we'll be able to correct. Remember, we had actually considered depreciation on what? 43. But now you've corrected it. The total amount you are correcting is 2. But we are charging 10%. So we correct 10% on this amount. So we'll be able to come and actually debit that amount in the property, plant and equipment. Because you had overcharged, we are correcting it. So we have to return it back to the property, plant and equipment. We return the 200. So it means what will be happening here, when we are consolidating, we'll be saying 10K plus 33K minus this particular what? Profit recognized. But now we are correcting also what? The overcharge of 200. So we'll be adding it. Because if you are debiting the property, plant, and equipment account, it means you are increasing it. So we'll likely basically be doing what? Be adding. We will be adding. We'll likely be adding. This one will likely be minusing. We'll be minusing. When you credit the cost of sale account, is an expense account. When you credit it, it means you're having to reduce it. This one basically means you are adding. You can put positive. This one means we are deducting. Deducting from what? The property, plant, and equipment account. We are deducting. We are minusing. So eventually, once you get used, you'll just be saying add to cost of sale. You'll be saying minus from property. Once you get used, you'll just be saying add to property, plant, and equipment, deduct from cost of sale, because you are crediting that account. You're having to credit what? That account. You basically deduct from what? From the cost of sale. You likely deduct from the cost of sale, like that. So that's what will likely be happening if you have, in this case, what? An intergroup sale of what? Of a fixed asset. And of course, you'll come across these what? Items in the additional information. So then number four, you can be able to write number four. You can be able to write number four, dividend from the subsidiary. Let's assume in this case, if this is the holding company that has acquired the subsidiary, it means this holding company is a shareholder here. If you're a shareholder in a company, what do you expect? You expect to get dividends. So it means this particular subsidiary will likely be paying dividends to this one. So what happens if in this case, this particular subsidiary has ended up having to pay what? As a dividends to this one? What happens? You can be able to write number four, adjustment. So if in any case, exactly what? A dividends from what? From the subsidiary company. So number four, dividends from the subsidiary. Number four, dividends from the subsidiary. What happens if in this case, there was a payment of a dividends by the subsidiary company to the holding company during the year? That is, like in this case, what? An intergroup balance. An intergroup payment or an intergroup balance that is having to be settled. What happens? You can be able to write dividend from the subsidiary. So number four, dividends from the subsidiary. Dividends from the subsidiary. Dividends from the subsidiary. What happens if there's a dividends from the subsidiary? Dividends from the subsidiary. Yes. So you can be able to write dividends are the distribution of profit to the shareholders. Dividends is the distribution of profits to the shareholders. Dividends is the distribution of profits to the shareholders. Dividends is the distribution of profits to the shareholders, full stop. Then you write and say, dividends may be paid out of pre-acquisition profits. Dividends may be paid out of pre-acquisition profits. Dividends may be paid out of pre-acquisition profits. Pre-acquisition profits may be paid out of pre-acquisition profits. Profits realized before the subsidiary was acquired may be paid out of pre-acquisition profits. You put in bracket, pre-acquisition dividends, pre-acquisition, we call it pre-acquisition dividends. The dividends that was actually paid by the subsidiary before it was acquired. So pre-acquisition dividends, or paid out of, or it can be paid out of, or paid out of post-acquisition profits, or paid out of post-acquisition. This is after acquisition, or paid out of post-acquisition, or paid out of post-acquisition profits, or paid out of post-acquisition profits. Post-acquisition profits, you put in bracket. This one we call it post-acquisition dividends. Post-acquisition dividends. Post-acquisition dividends. Post-acquisition dividends. So there can be a scenario whereby, for example, we have the whole year. So 1st of January 2024, we have 31st of December 2024. So the subsidiary can actually be acquired here. Maybe it can be acquired on Fool's Day, 1st of April 2024. So it means this particular subsidiary has only existed for how many months? 9. Is it 9? Yes, 9. So 9 out of 12. Then the pre-acquisition period, because this particular subsidiary, they would have prepared their accounts for the entire year. So maybe they have reported the profits for the entire year. The profits for the entire year is maybe in this case what? 6 million. Exactly in this case what? 6 million. And in this case, we have the pre-acquisition period is actually 3 out of 12 plus the other periods behind that there could be some retained earnings there. So this becomes the pre-acquisition period. This one becomes the post after it was actually acquired. So it means when you're having to pay dividends to this holding company, because this subsidiary was acquired by a holding company, we cannot actually pay for the whole year. This profit, the whole of them cannot go to this one. They'll just be able to apportion for only how many months? 9. Because now in this case, they'll only be able to enjoy in this case what? Post-acquisition what? Dividends. But of course, they would have already paid some dividends for what? For the 3 out of 12. So this one that is actually paid before the acquisition, we call it what? Pre-acquisition dividends, which is for the 3 months and the period behind. But the one that in this case they're having to enjoy after the acquisition is now the post-acquisition what? Dividends. Is the post-acquisition dividends. So that's what you're having to say. The dividends may be paid out of pre-acquisition profits, in brackets, pre-acquisition dividend, or paid out of post-acquisition profit. We call it post-acquisition dividend. So full stop. Then you write and say, the parent share of pre-acquisition dividend, the parent share of pre-acquisition dividends, the parent is the holding company. The parent or holding company, the parent or holding company, share of pre-acquisition dividends, dividends that was actually settled before they were acquired, or the portion of dividends for before they were acquired. The parent share of the pre-acquisition dividend is to be credited to the cost of investment, is to be credited to the cost of investment. It is to be credited to the cost of investment, is to be credited to the cost of investment. So in this simply means you put a semicolon. This simply means this is what will happen. You'll actually in this case debit, because when the company is, the holding company receives, they'll debit the cash or bank. That is, in this case, it has already been paid. If it is yet to be paid, in this case, they'll actually end up having to debit what we call dividend receivable account. Dividend receivable account. Then in this case, they do what? They credit. They actually, in this case, credit what we call the cost of investment. They'll, in this case, credit what you call what? The cost of investment account. Debit what you call what? The cost of investment account. So this is what it means. There'll be something you'll likely be given. So you'll see something like this. You'll likely see something like this. You'll see something like this. You'll likely see something like this in there, what you'll be presented with. This cost of investment will likely appear. So you'll see in this case, the accounts for the holding company, in fact, it will likely be the statement of financial position. The statements of financial positions for the two companies. You'll see something like this in the question. So you'll be told, you'll see items of non-current assets. You'll see those items. You'll see maybe property, plant, and equipment. You'll see maybe in this case what? What else can be there? There'll be other items. But of course, in this case, also you can be able to see in this case what? Investment. So you can be able to see in this case maybe what? Cost of investment. So for this cost of investment, so for this one, they'll tell you, for example, you'll see the items, they're appearing in both. For PP, you'll see it is appearing in both. You'll see maybe this one, they have said 10K. This one, they have said 30K. But here, this cost of investment, you won't see it here. They'll put a dash here. They'll put a dash there. But now you'll be able to see it in what? In the holding company. You'll see maybe they have indicated 5K. So it means this is basically the cost they incurred to basically, in this case, acquire what? The subsidiary. Because you don't just acquire the subsidiary empty-handed. You have to pay. So that's the amount they did. It's like in this case, having to say what? Investment. investment. You know, when they acquire the subsidiary, they have made an investment. When you buy shares in a company, you have made an investment as an individual. The same case. When a company buys shares in another one, it has made an investment. It becomes an asset. It becomes what? An asset to it. So, but now it won't appear here. So what we're having to mean, if in this case, you do the computations, you realize that there's a portion of the pre-acquisition dividends that in this case is having to be paid to, in this case, what? The holding company. Then it means you likely end up having to eliminate it from what? From the cost that was incurred to buy the subsidiary. It will be reducing it. It will be reducing that amount they are having to incur to buy what? The subsidiary. And of course, when you receive, you can actually be paid cash. So it means you'll likely be able to do what? You debit the cash account. Of course, in this case, now the cash account will appear under what? The current assets. So you'll be given, in this case, cash. Or maybe you can be given cash and, of course, also in this case, what? Bank, or cash or bank. Most of the time, they'll be able to tell you cash or bank. Maybe cash or bank. So it continues. The question continues. Maybe this one is actually 6K. This one is maybe 3K. So it means these dividends you've actually been able to receive, you'll actually basically be saying 6K plus 3K plus that dividend received, because it is increasing. If it was paid by cash, if it was paid by what? By cash, you'll actually end up having to increase it. Maybe you actually paid their dividends of 1K. So you'll add so that you can get the consolidated figure of what? Of cash, because the holding company is receiving this cash. It is actually increasing here directly. It is increasing here directly, but you just say 6K plus 3K plus 1, because this one is increasing here directly. You just basically say plus 1K here, but now you just put at the end here to get what? The consolidated what? Cash or bank for the two, because it was receiving the cash in form of dividend, you put it there. But if it has not yet been paid, you know, it can be inaweza kuwa deni. So the subsidiary is yet to pay. It becomes a receivable. It becomes a receivable, and still it appears as an asset. So now in this case, you won't actually be able to add it here, but you'll be able to say, you'll create in this case another current asset. You call it dividend receivable. You put that 1K. You recognize it separately from the cash, because it was not received as what? As cash. While in this case, you deduct from the cost of what? Investment, because it is ideally, like in this case, the subsidiary is having to do what? Pay. Is having in this case to do what? To pay the holding companies. And therefore, in this case, you eliminate it from what? From the cost they incurred to buy that what? Subsidiary. So that's what will happen. Then we can have in this case, if still the same case, if the parent share of post-acquisition dividend is a return on investment, is an investment income, if you can be able to write and say, if the parent share, we can be able to write and say, if the parent share of post-acquisition dividend, if the parent share of post-acquisition dividend, this is now another point. If the parent share of post-acquisition dividend is a return on investment, a return on investment, or you can put in brackets, is an investment income, is a return on investment, or is an investment income, you likely end up having to, in this case, debit. You likely debit in this case the cash, or in this case the bank, just the same entry, cash or bank. Then in this case, you likely credit, you'll credit investment income. You likely credit the investment income. This one is actually in the P&L. This is after they have actually already been able to do what? Make the investment. So if they were paid dividend, that is actually, this one is now what? Post. Remember the other one we are having to deal with was pre. This is the post, after they have acquired. Now after the subsequent 9 months, you likely in this case recognize that one as what? As an income. But of course, because they received cash, you'll be able to debit what? The cash account. This one actually appears in the statement of financial what? Position. So you likely increase it. But now the investment income in the SIM statement of income, this one you likely end up having to do what? To credit, because it is increasing that what income you are receiving from an investment. Is increasing that, is it now an investment income? It is now what? An investment income. So you'll likely be able to recognize it under what? The investment income. We'll recognize it under the investment income. So hope you've actually been able to capture that. Hope you've been actually been able to capture that, because now in this case, I want us, we look at a another important area, another important area. We call it goodwill. We call it goodwill. We call it goodwill. We call it goodwill. So we can look at goodwill. So number 5, you can write goodwill. Number 5, you can write goodwill. How do you treat goodwill? Goodwill on acquisition. Can be able to write goodwill on acquisition. Goodwill on acquisition. So goodwill on acquisition. Goodwill on acquisition. So the goodwill on acquisition. Goodwill on acquisition. So number 5, you can write goodwill on acquisition. Goodwill on acquisition. You write goodwill on acquisition. Goodwill on acquisition. Goodwill on acquisition. Goodwill on acquisition. So in this case, you know, when you purchase a subsidiary, when you end up having to purchase a subsidiary, it's not a matter of, in this case, having to acquire just only the normal assets. And of course, like in this case, what maybe the incomes they had, you take over, or the expenses they had, you take over. But there's in this case like a value that is attached to that subsidiary, which in this case will likely lead you to having, in this case, what future economic benefits as a holding company. So this value that is actually far beyond the physical assets you're having to acquire, which is attached to the business that you'll be able to enjoy in future, we call it what? Goodwill. For example, if you buy the subsidiary, let's say in this case you're having to control like maybe 90%, you'll actually basically benefit because you'll, for example, take over what? The customers. You can see the value you'll be able to get is just far beyond even the buildings, acquiring the buildings of that subsidiary, the equipments, the assets, the computers. It is far beyond, because these particular customers that you've already taken over, they likely bring value to you as a holding company in future. So of course, this has to do what? It has to be valued. Now in this case, it is basically ends upon having to do what? Be called what? Goodwill. Goodwill. So in simple terms, you can actually end up having to say goodwill is actually ideally in this case the value that is attached to that subsidiary by the virtue of what it repute already what in the market. If in this case we're having in this case what maybe a holding company, let's say for example in this case it is 𝐧𝐞𝐰𝐬 Bank, it is having to acquire what 𝐧𝐞𝐰𝐬 Bora Bank. So if they don't just acquire their buildings, and in this case maybe their computers and their staffs and everything, they take over their expenses, they start having to service. No, there's already customers that were there for 𝐧𝐞𝐰𝐬 Bora Bank. You've actually in this case started at a higher notch compared to in this case a person who will end up having to start from scratch. So from these customers, you can actually be able to get value in future. So it can't actually be valued ideally in this case in terms of what matters of the assets you've acquired. It is far beyond what you're acquiring as the physical assets, which in this case has to be valued. This is what we call what? Goodwill. So this goodwill on acquisitions or takeovers, or in this case the holding company acquiring the subsidiary, it has to be valued. It has to be valued. The value attached to that particular business that in this case will be able to bring upon what? Future economic benefits to you as what? As a holding company. So we call it what? Goodwill on acquisition. So you can be able to write this about goodwill on acquisition. So IFRS number 3 defines goodwill as, IFRS number 3 defines goodwill as future economic benefits arising. IFRS number 3 defines goodwill as future economic benefits arising from assets that are not capable of being individually identified, from assets that are not capable of being individually identified, from being individually identified, full stop. From being individually identified, full stop. From being individually identified, full stop. Then you write, goodwill is computed as follows. 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 Goodwill is computed, is generally, you can be able to say goodwill is generally computed as follows. Goodwill is generally computed as follows. Goodwill is generally computed as follows. It is generally computed as follows. It is generally computed as follows. You can be able to say, you can be able to say, you can be able to say, you can be able to say. So goodwill, you can be able to say goodwill is equals to the purchase consideration is equals to the purchase consideration is equals to the, and this one you remember what we learned in conversion of partnership. So that is a general formula. The purchase consideration, or in this case, we can be able to say the cost of investment. Cost of investment. You deduct in this case what? The net assets acquired. You deduct the net assets acquired. You deduct the net assets acquired. This is like in this case what the general formula. You are basically taking that cost of investment I was trying to explain there that is appearing in the holding company. You deduct the net assets acquired in the subsidiary. The net assets basically is the equity part. It is the equity part of what? Of the subsidiary. Or you can be able to say total assets minus total liabilities. You can say total assets minus total liabilities. You are basically taking the equity part. That equity part, there's a portion of it you've actually been able to acquire. If in this case you acquire 80%, it means you've acquired 80% of it, but now the remaining equity part of 20% is having to be controlled by what? By the minority. But now in this case here, we don't call them minority, we call them the non-controlling. They're not controlling, the non-controlling interests. We call them the non-controlling what? Interest. But you are the one controlling because you are in the majority, you have acquired a subsidiary. So the ones that are remaining in that equity, because there's a portion of it you've acquired, they are the NCI, the non-controlling interest. They become the non-controlling interest. So if it is 80% acquisition, the remaining 20, they are not controlling. We call them the NCI, the non-controlling interest. The non-controlling. So this is the general what? Formula, the general formula. So you can be able to write methods of computing goodwill. You can be able to write methods of computing goodwill. Methods of computing goodwill. Methods of computing goodwill. So there are two major methods. So methods of computing goodwill. Methods of computing goodwill. Methods of computing goodwill. The first one, you write number one. The first one, you write number one, the full goodwill method. The full goodwill method. The full goodwill method. You write number one, we call it the full goodwill method. The full goodwill method. The full goodwill method. Then you write this about this. It is where the goodwill of the subsidiary is determined as a whole. It is where the goodwill of the subsidiary is determined as a whole. You take it fully. You don't apportion some to the non-controlling interest, but you take it fully. You take it what? Fully. You fully take it. You take it fully. You don't apportion some to the non-controlling what? Interest. You don't apportion some. You take it fully. So in this case, it means it is where the goodwill, this is where the goodwill of the subsidiary is determined as a whole. Is determined as a whole. Full stop. Is determined as a whole. Full stop. The goodwill comprises the parent. The goodwill comprises the parent and NCI goodwill. 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 NCI is non-controlling interest. So remember, I've been able to say that these net assets, you'll be able to acquire. So, you know, when you buy, you are buying the shares. And of course, the net assets predominantly in this case, you're talking about equity shares. Let's say, for example, you've acquired 80%. So 80% you're able to control. It is your controlling interest. But now the remaining 20% is non-controlling. But now remember, at that particular point in time, the subsidiary is having to be acquired. There's a value attached to that subsidiary with regard to what its repute, which is basically in form of what the future economic benefits that will be able to arise. We have to value it. when you value it, it could be 100K. It could be 100K. So it means if you are taking over 80%, ideally, we would actually basically supposed to be controlling what 80% of that goodwill, 80K. And then the 20K is supposed to be, in this case, be controlled by what? By the NCI. It's supposed to be taken over by what? The minority 20%. They're the ones who are supposed to enjoy it. But now, under the full goodwill method, if you are calculating goodwill, it means that in this case, we are fully having to take over what? The entire goodwill as part of what you'll be able to do what? Include in the consolidated financial statements as what? As an asset. So we take it fully. We actually take it fully. We don't actually basically limit and some remains with them, but now in this case, we take it what? Fully. That's why we call it what? The full goodwill method. The full goodwill method. So in this case, this is how you determine it. You can be able to write, it is determined as follows. It is determined as follows. This is how you'll be able to calculate it. It is determined as follows. 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 So you'll be able to, in this case, you'll take the purchase. You'll be given a purchase consideration. The purchase consideration. You will take the purchase consideration. So, of course, here we have shillings. So, you'll be able to take the purchase consideration. On this purchase consideration, you'll add on the fair value of non-controlling interest. Fair value of non-controlling interest. Fair value of non-controlling interest. You'll be able to add it there. So, what will happen in an exam, in the question, you'll see there is a additional information somewhere. You know, in the additional information, which actually in this case, people are just fearing. When they see a FAR paper, they are fearing that additional information. So in the additional information, the examiner will tell you something. He'll tell you that the fair value of non-controlling interest was 6 million. He'll tell you like that. He'll tell you like that. You'll see one of the additional, you'll see 1, 2, 3. They have told you a lot of stories. Intercompany sale. They have told you sale of it. You'll reach a particular point. Maybe it could be 3. The examiner will be telling you that the fair value of the non-controlling interest on acquisition was 6 million. If you see that statement, don't think twice. Don't think twice. The examiner wants you to use what? The full goodwill method to calculate the goodwill. Don't think twice. When you see that in the additional information, fair value, FF, full, fair, full, fair value. Use this method you are trying to display here to calculate what the goodwill, because the goodwill will likely appear in your statement, consolidated statement of financial position as what? As one of the assets. Is in this case a computation you can't miss out to do what? To calculate. So if you see in any of the additional information, the examiner is telling the fair value of the, don't think twice. Remember this method, calculate the goodwill. That's what is supposed to do what? Appear in the statement of what? Financial position as part of what? The assets. So this goodwill is actually an asset. Is an asset. It is basically valued as what? As an asset. So once in this case you are consolidating, as you are putting there property, plant and equipment, maybe it could be investments. Also, in this case, you're supposed to put there what? Goodwill, which in this case you would have actually been able to calculate here. You would have calculated it here. So this is how you calculate it. You take the purchase consideration. This is basically the money that was paid to acquire the subsidiary. The money that was actually paid to acquire what? The subsidiary. You'll be told, maybe in this case, not in the statement of financial position, it was this batch. Then in the additional information, there'll be a custody by the examiner. The fair value of the, don't think twice. Just know that in this case, he wants you to use what? The full goodwill method. So you'll be able to, in this case, take that purchase consideration, you add on the fair value of the NCI, which you would have actually been given. You would have actually, in this case, actually done what? Been given. So you'll actually be able to, in this case, add it. You'll get a figure there. Then once you get that figure, remember we've been able to say the general formula in this case is to do what? To consider the net assets. In this case, you'll be able to, in this case, less net assets acquired. You less the net assets acquired. You less the net assets acquired like that. So how do you get the net assets acquired? You basically look at, you go to the equity part of the subsidiary. These ones, you'll get them on the equity part of the subsidiary because you would have actually been given for the holding company and the subsidiary. Go to the equity part there. Go to the equity part there. You'll be able to see some items. The items you'll be able to pick, in this case, it is ordinary share capital. Ordinary share capital. Ordinary. You'll pick ordinary share capital. Ordinary share capital. There was supposed to be another column here. I don't know whether you'll be able to fix it. So that in this case, you can have these ones having to come here. Don't come in this column, but they have to come in because I'll then consider them here. So in this case, you'll have ordinary share capital. You'll see in this case also what share premium. Bring it here. Share premium. Bring it here. You'll see also share premium. Bring it the way it is here. Bring it the way it is there. The way it is there. Then these ones now will actually basically not actually be there, but in this case, you'll have to consider them. So in this case, you'll have pre-acquisition retained earnings. Pre-acquisition retained earnings. You'll have to put them there. Pre-acquisition retained earnings. Then in this case, you have what? Pre-acquisition reserves. Pre-acquisition reserves. Pre-acquisition reserves. Pre-acquisition reserves. Pre-acquisition reserves. In this case, you'll likely be able to have, in this case, what? You'll have to put them there. You'll be able to put them there. Then in this case, you add this particular figures. Then in this case, you deduct from the value you would be having up there. You deduct from this value here. You deduct. So once you deduct, you'll likely in this case be able to get what? The full goodwill on acquisition. The full good. You'll be able to get the full goodwill on acquisition. So once we do a question, you'll be able to understand. You don't have to worry so much, but now that's how you'll be able to get it. So these particular two items, you'll pick them. You'll actually pick them from the equity part of the subsidiary. Because in this case, you would have actually been given the equity part of the two companies in the question. There'll be those of the holding company and those of the subsidiary. So of course, we start with what? Non-current assets. We go to the current assets. Then we go to what? Equity there. So the equity part here of the subsidiary, you'll be looking. Is there ordinary share capital? You pick it and bring it there. Is there share premium? You pick it and actually bring it there. But for this one, the pre-acquisition retained earnings, this one you'll end up having to calculate, or you can actually be given the additional what? Information. You'll be able to bring it here. Then the pre-acquisition what? Reserves. The reserves that were there before the subsidiary, before acquisition. These figures, you pick the ones before acquisition. They'll normally, in this case, be given in what? In the additional information. You pick them in this case and you do what? You bring them here. You add them. So that in this case, you can actually end up having to get what? The value of the net assets, which are actually, in this case, what? Acquired. Remember, these basically are still what? Part of what? The net assets, part of the equity. But now these ones, you pick what? The ones that were there before the company was acquired. So you pick them. And of course, now in this case, you bring them here, you add, then you deduct. When you deduct, you get what? The full goodwill on what? On acquisition. So these are basically, in this case, you use what? The full goodwill method. Or we can be able to have another one, which is usually very rare in the exam, but still it can actually be examined. We call it the partial goodwill method. It's not that common in the exam, but in this case, the examiner likes this full goodwill. This partial, rarely it will appear, but you have to know it because once in a while, they test it. Once in a while, they test it. So number two, we have in this case what we call what? The partial method. The partial method. The partial method. The partial goodwill method. Partial goodwill. Partial goodwill method. The 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 partial goodwill method. So you write this about the partial goodwill method. You write this about the partial goodwill method. This is where only the parent goodwill is recognized. This one is now partial. You don't consider that one for the NCI. This now is partial. You say it is where only the parent goodwill is recognized. It is only where the parent goodwill is recognized. It is only where the parent goodwill is recognized. And the non-controlling interest is measured at their proportionate, and the non-controlling interest is measured at their proportionate, and the non-controlling interest is measured at their proportionate, share, at their proportionate share of the fair value of the subsidiaries' net assets. and the non-controlling interest, or the NCI. Now you need to get used to having to call it just NCI. And the NCI is measured at their proportionate share of the fair value of the subsidiary net assets, It is determined as follows. 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 These are now you basically calculate the partial goodwill method, how you use the partial goodwill method to calculate. It is determined as follows. 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 This one now, you take the purchase consideration. You take the purchase consideration to be able to put the figure there. But now you don't consider the fair value of NCI. So you go directly, in this case, what? To less the net assets. You go directly to less the net assets acquired. The net assets acquired. Then you consider, under the net assets acquired, you consider ordinary share capital. You consider ordinary share capital. So you'll be able to place there. You consider if there was a share premium, you consider it. Share premium. It is part of the net assets. You consider it. This one you pick from the equity part of the subsidiary. Then in this case, the pre-acquisition retained earnings will also be considered. You need to be able to put them there. Then also the pre-acquisition reserves. You also consider them. The pre-acquisition reserves, you consider them. You'll be able to get a total. This total, you multiply by the percentage of control. So this total you get here. So this one, you multiply by percentage of control. Maybe in this case, it is 80%. So the percentage that in this case, the holding company is having to do what? Control. Because it is partial. What are they controlling? If it is 70%, you take 70% of this figure, these net assets. Because you're not using the full, you just take a proportion of what in this case they're having to control. So in this case, you take that percentage, you multiply, then you'll be able to get a figure. Once you multiply by the percentage of control. You'll be able to get a figure. When you get that figure, you put it here, then you deduct from this one. You'll actually be able to get now in this case what? The goodwill. You'll be able to get now in this case what? The goodwill. You'll get the goodwill. You'll be able to get what? The goodwill. So you'll be able to get the goodwill like that. If you want to know, in this case, the examiner wants you to use the partial method. Then in the addition, remember for full goodwill, I've told you in the additional information, you'll see the examiner having to say NCI was measured at a fair value of what? Was valued at a fair value. When you see this statement, don't think twice. He wants you to use what? The full goodwill method. So F, full fair value. He wants you to use in this case what? The full goodwill. Fair value. He wants you to use what? The full goodwill. Don't think twice. When you see in the additional information, the examiner is having to give you this statement you've just written. That the NCA is measured at their proportionate. This one you use what? Partial. You use in this case what? Partial. When you hear in the additional information that in this case the examiner is having to say that NCI is valued at their proportionate. At their proportionate. P and P. At their proportionate. He wants you to use what? The partial. He wants you to use the partial to calculate that goodwill. That's how you can be able to know which method am I going to use, because he won't tell you. The examiner will just tell you these stories in there. He won't tell you, I want you to use proportionate, but now I've given you the secret. If you see because they'll tell you in the additional information, the fair value of NCI, When you see that statement, don't think twice. They want you to use what? The full goodwill, F and F. If in this case, he's having to talk about the NCI is valued at their proportionate. Don't think twice. He wants you to use what? The partial method, P and P, F and F, F and F. That's why you'll be able to know which method does the examiner want. Because he won't tell you. He won't tell you. Because you've seen two methods, but he won't tell you. He'll tell you that kind of like a statement in the additional what information. So that's why you'll be able to know which method am I going to, in this case, utilize. Which one am I going to, in this case, do what? Utilize in having to prepare what? The financial statements. In having to prepare the financial what? Statements. The financial statements. Yes. So what is remaining now? So do we need to start looking at our question? Or in this case, what is remaining now? Let's see what is remaining before we start having to sing stories about doing an illustration from the past paper. Which major story is remaining? Which major story is remaining? Which major story is remaining? So there's another one in this case. They can be what you call fair value adjustments. So that could be the one that I need to be able to look at before we start having to sing stories about questions, stories about illustrations from the past papers, before we start having to sing about stories about illustrations from the past papers, from the past papers. So we have what we call fair value adjustments. I don't know if it is number 6 or it is number 7. Is it number 6 or number 7? Cyprian, is it number 6 or number 7? Is it number 6 or number 7? Michelle, is it number 6 or number 7? Is it number 6 or number 7? Number 6 or number 7? It is number 6, eh? Number 6. You can be able to write number 6. Number 6. Number 6. Evans was asking me to repeat something. I don't know what he wanted me to repeat, eh? Maybe you can type there. I will repeat, eh? So number 6, eh? Number 6, eh? Number 6, you can write fair value adjustments. Fair value adjustments, fair value adjustments, fair value adjustments. So sometimes on the point of acquisition, the assets acquired might be revalued. The assets acquired might be revalued. For example, they might tell you that in this case, under property, plant, and equipment, an item which was in this case worth 60 million, on acquisition, it was revalued from 60 million to 80 million. So that means in this case, their fair value would have has to be adjusted. So as you start to consolidate, you have to consider that what revaluation. Because once you combine the books of accounts, the value won't actually be at 60. It'll actually basically would have actually been adjusted. So when you talk about fair value adjustments, they can occur. On acquisition, they'll say that in this case, the property and equipment or an item of PPE was revalued by this. Maybe it went down, or maybe in this case, it went up like that. So those revaluations in this case have to be considered, or in this case, what on acquisition. So you'll have to in this case consider them when having to in this case now start having to do what? Consolidate. When you start having to do what? To consolidate. To consolidate. So in this case, you can be able to write IFRS number 3. IFRS number 3 requires the identifiable assets and liabilities. IFRS number 3 requires the identifiable assets and liabilities IFRS number 3 requires the identifiable assets and liabilities of the acquiree, the company having to be acquired, of the acquiree to be measured initially by the acquirer, at their fair value at the acquisition date. 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 Full stop. When the subsidiaries company's assets are revalued on acquisition, when the subsidiary company's assets are revalued on acquisition, when the subsidiary company's assets are revalued on acquisition, 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 comma, are revalued on acquisition, comma, the subsidiary may have not incorporated, the subsidiary may have not incorporated, the subsidiary may have not incorporated the revaluation, the subsidiary may have not incorporated the revaluation in its own books, may have not incorporated the revaluation in its own books, may have not incorporated the revaluation in its own books, full stop. In this case, the revaluation needs to be adjusted. In this case, the revaluation needs to be adjusted before consolidating the subsidiary. The revaluation needs to be adjusted before consolidating the subsidiary. Before consolidating what? The subsidiary. Full stop. A depreciation adjustment may also be required. A depreciation adjustment may also be required for assets which are to be depreciated, for assets which are to be depreciated, for the 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 assets which are to be depreciated. For the assets which are to be depreciated. For the assets which are to be depreciated. So, so that is in this case what we mean by fair value adjustment. Of course, when we do a question, we'll be able to see how we'll be able to adjust that one. So I think those are like in this case the major adjustments. So I want us in this case now, I think not from today. Let's start tomorrow. So tomorrow we'll start by having to look at now a full question on these matters consolidation. So in this case, we'll be able to start with this particular question here, September. We look at so many questions because these are very crucial topic. We'll start with September 2015. You can just go through it. September 2015 question number 1. That is the one we'll be able to start with. We'll be able to start with that one. Then we see how far we'll be able to go. So we'll start with September 2015 question 1. September 2015 question 1. Then we'll also do this one. September 2015 question 1. We'll also do which other one? November 2015 question. We'll do November 2015 question 5. So November 2015 question 5. We'll do also this one. November. You can just go through them. Don't attempt them. You just go through them. Don't attempt them. Amongst others, we'll do like in this case, like 4 or 5 questions. This is what we'll basically be dealing with from tomorrow, also the entire of next week. 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 So that's what in this case you'll likely be able to look at a number of questions as to in this case you can actually be able to solve them. So you need to be very keen as to what will be happening when you'll be doing the questions or the illustrations. You can see the kind of interesting adjustments we've just been able to discuss here. They are very nice, very nice. So now in this case, now we'll be seeing how eventually in this case now you deal with them if you have like a question now at hand. How do you end up having to deal with them? So that's in this case what we'll be tackling from tomorrow. So from tomorrow. So sorry, today we began a bit late. I had a problem, a challenge here and there with my internet. So I had to change or shift studios. I had to shift studios, so which consumed some time. But now tomorrow, we'll start with this one, then do this one. Then of course also, tomorrow we'll be meeting lunch hour. There's that question I had actually shared for assignment for cash flow. We'll try to do it. I don't know whether we'll be able to complete it during lunch hour, but we'll be able to see what will happen that lunch hour. We'll also tackle that cash flow question, which I had given as an assignment. We see how you can be able to handle it. So I think with that, it will be okay. So we can just be able to end there. We can just be able to end there. We catch up tomorrow. Unless there's a very burning question, you can be able to ask. You can be able to ask. Remember, we are targeting to finish the syllabus, hopefully before the end of the month. Hopefully before the end of the month. So we have like a marathon to do in the next 20 days. So today is 10th. So by 31st. So in the next 20 days, we have like a marathon to be able to cover. But once we are through, this is now the most hectic topic. The most hectic topic that we are remaining with. The most hectic, it is this one. Then the ones that will follow, the public sector. Public sector is just very nice things, very nice things. Then financial statement analysis, very nice things. So it's not that difficult. So those who are able to join, there's a particular class I did for common size statement, vertical. You see how vertical is very simple. So those ones are not, they are very light. So the last two, public sector, financial statement analysis, very light. But this one is a bit heavy. So once we are through with this one, then the other ones will be able to just go through them very fast, and we'll be through. So hopefully by the end of this month, God willing, we should be through with the syllabus. We should be starting block revision by the first day of August. We should be starting. So we'll see what will happen. We'll see what will happen before then. So I think that's it. So that's it. I pardon the first statement on fair value. But of course, now in this case, on fair value adjustment, the first statement on fair value adjustment, okay? The first statement on fair value. So IFRS number 3 requires the identifiable assets and liabilities. IFRS number 3 requires the identifiable assets and liabilities of the acquiree to be measured initially by the acquirer at their fair value, to be measured initially by the acquirer at their fair value at the acquisition date. IFRS number 3 requires the identifiable assets and liabilities of the acquiree. Acquiree is the company being acquired. Acquiree to be measured initially by the acquirer, the one acquiring, at their fair value at the date of what? Acquisition. At the acquisition date, or at the date of acquisition. At the date of acquisition, or at the acquisition date. So that's what in this case we said there. So the things we've discussed here, when you do the questions, you'll see them. So you'll see them now at hand, how we basically deal with them. How we squarely deal with them, but now we'll be doing a question. Otherwise, thank you very much. You can have a good night. So just relax and read what we've gone through. Then you go through those illustrations I've been able to say we'll go through. Don't attempt them at all. Don't try to attempt them at all. Don't try to attempt them. You just go through what we've learned here. Then just read the questions and look at them. Then tomorrow we'll now be going through. We'll be going through as we tackle them like that. So that's what in this case is actually very, very important. Otherwise, have a good night. So let's catch up tomorrow. Thank you very much.